When you reach age 59 and a half, you can withdraw money from your 401k or other retirement accounts penalty-free. Withdrawals before that age incur a 10% early withdrawal penalty. This creates a dilemma for those who want to retire early and need access to liquidity before they hit that age. But what many people don't realize is that there are a few perfectly allowable loopholes you can use to tap into those funds without incurring the penalty. Now, there are some rules that allow for hardship withdrawals as well in cases like disability or natural disaster, but for this discussion, we're going to focus on distributions that you can use for anything you wish. Before we dive in, please be aware that some of these strategies are complicated and might require additional tax filings. So please consult your financial advisor or tax preparer if you're considering any of these options. First out, the 60-day rollover. If you need cash in a pinch and can repay yourself within a short time frame, this is a quick and inexpensive option. This rule allows you to withdraw funds from a retirement account. Then, if you can repay the full amount within 60 days, you can avoid the usual 10% early withdrawal penalty, and it won't be considered taxable income. Now, here's a little trick. If you're married and your spouse also has a retirement account, you can actually stretch this to 120 days by replenishing the funds in one of your accounts with funds from the other's account, and then paying back that second account within the second 60-day period. One of the more common cases we've seen clients use this for is to help fund a down payment on a new home that's needed before they sell their current property. They'll pull the money needed for the down payment from their IRA when they close on the new property. Then, once they're able to sell their previous home, the proceeds from that sale can be put back into their retirement account and no penalty or taxes apply. The one catch with this rule is that you can only do one 60-day rollover within a 12-month period. Next, let's talk about Roth IRA contributions. One of the really great features of Roth IRAs is that you can withdraw your Roth IRA contributions at any time for any reason without incurring taxes or penalties. For example, let's say you've contributed $50,000 to your Roth IRA over the years, and it's now grown to $100,000. You can take out that original $50,000 you put in, even if you're not 59 and a half, without incurring the early distribution penalty. The remaining $50,000 of earnings may be subject to taxes and penalties, except if used in certain circumstances, which we won't get into in this video. Another option for liquidity is a 401k loan. If your employer's plan allows it, the IRS permits you to make a loan from your 401k. The loan can be up to $50,000 or half of your vested balance, whichever is lower. The interesting part here is that rather than paying interest to an outside lender, you actually pay interest back to yourself at a rate set by the plan. This option can often be quicker and require much less paperwork than getting a loan from an outside lender. Now, there are some downsides. You have to pay yourself back with after-tax money, which means you'll essentially be taxed twice if you eventually withdraw that money down the road in retirement. There's also the opportunity cost of lost market returns while the loan is outstanding. And a big one to remember, you may have to pay the loan back in full if you leave your job. If you can't pay the loan back, it will be treated as a distribution, which would then incur taxes and that 10% penalty if you're not 59 and a half. Next up is the substantially equal periodic payments rule, also known as the 72T rule. The IRS allows people under 59 and a half to withdraw money from their retirement accounts if the distribution is part of a series of substantially equal payments over the course of 5 years, or until age 59 and a half, whichever period is longer. You are still taxed on these distributions, but you won't be on the hook for that 10% early withdrawal penalty. This is definitely the most complicated option and has very strict guidelines for calculating the payment amount. Once it's established, you can no longer contribute to the account or take additional distributions. Given these complexities, I really wouldn't even consider this option without the help of a financial professional or tax advisor. And the last strategy we'll discuss is the rule of 55. When you hit age 55 or older, you can utilize this rule if you lose your job or retire early. This allows you to withdraw money from your 401k at your most recent employer without incurring the 10% early withdrawal penalty if you're no longer working there. Unlike the 72T rule, no calculations are necessary, and there's no restriction on the timing or amount you can withdraw, making it one of your most flexible options. However, keep in mind, this does not apply to IRAs or retirement plans held at a previous employer. This is a frequently overlooked reason why you should roll your 401k dollars from a previous employer plan into your current employer's retirement plan. If you have any questions or want to discuss this in more detail, please feel free to reach out to me at nick@slaytonlewis.com.